In this video, I will break down a powerful section where 15 struggling traders sit down with Umar Ashraf, a verified trader with over $30 million in profits. Umar identifies their core mistakes and gives specific actionable fixes. This summary covers the key lessons. If you are serious about stopping the cycle of overtrading, revenge trading, and broken rules, pay close attention. Part 1. The foundation. Rules versus emotions. The first trader admits to not following his plan and switching strategies. Umar immediately corrects a common myth. You cannot eliminate emotions. Instead, you build a framework. The key is that you need hard rules, like laws that punish bad behavior. The fix is simple. You have already identified the problem, which is half the battle. Now, create specific rules around your known impulses. The action step is to establish a maximum trade count and a maximum daily drawdowns. Part 2. Disconnect from past outcomes. A major trap is connecting today's trading to yesterday's or last week's results. The key point is that a good month can make you overconfident and stupid, while a bad month can make you to be afraid to take your best setups. The fix is to disconnect from previous losses and wins. Each day is a new game. The advanced rule is to aim to trade less than 10 days out of 20. Only look to size up aggressively on 5 or 6 of those days. Create a structure of no trading days. Part 3. The 2 biggest mistakes: cutting winners and adding to losers. One trader reveals that he cut his winners early but adds to his losing positions. The key point is that this is the opposite of what works. You need to let your winners run and cut your losers short. The fix is that if you had to pick one change to make, hold your winners longer. Review your past 10 trades to prove this to yourself logically. Part 4. A+ setups versus C setups. Sizing is everything. A funded trader admits he risks the same amount on every trade, whether it is an A+ setup or a B- setup. The key point is that in your development stage, keeping size consistent helps you measure your strategy. But to make real money, you must size up on high probability A+ setups and size down or skip C setups entirely. The fix is to cut out C+ setups completely. Only focus on A+ setups. This forces you to trade less. Ask yourself how you can make the most money doing the least amount of work. Part 5. Strategy hopping and insecurity. A trader feels insecure because her simple strategy of trend lines feels like kindergarten. She starts tweaking it and adding things. The key point is that if a strategy was working, why change it? Your insecurity does not matter to the market. The market will take your money regardless of how you feel about your methods. The fix is to remember that win rate is a distraction. Focus on risk management instead. A 40% win rate with a risk to reward of 1:3 is better than an 80% win rate that blows up on one trade. The action step is to do more with less. Use process of elimination. Add only one new variable at a time and test it for weeks before making any further changes. Part 6. Outside noise and live copy trading. A trader admits that he gets distracted by news, the economy, and watching a mentor trade live. The key point is that the economy is not the market. Let price dictate the reaction, not your assumption about what should happen. The warning is that if you are a developing trader, you should not watch people trade live. You will copy their trades without building your own thesis. You collect no real data on yourself. You are not building a career for 10 or 20 years by following someone else's entries. Part 7. The 100 trade a day scalper. A new trader of 11 moons admits to taking up to 100 scalp trades a day. He has a sticky note on his monitor that says, "I will not overtrade." It does not work. The key point is that there is no human way to process that many decisions. You are effectively taking 100 random trades. Your data becomes a nightmare to analyze. The fix has 4 steps. First, cut your trades down to less than 10 per day. Second, use only one-time slots, such as the first 90 minutes of a section. Third, walk away from the computer at a hard stop time. Fourth, if you cannot follow a sticky note, develop discipline in your personal life first. For example, wake up and jog for 10 minutes every day for 30 days. Self-control bleeds over from one area of life to another. Part 8. The break-even trap and reducing risk. A trader says he stops after 2 losses, but after a break-even day, he takes one more trade just to go green. It never works. The key point is that your data already proves this does not work, but your brain keeps asking, what if it is different now? It never is. The fizz is that when you hit your break-even or loss limit, you do one of 2 things. First, walk away immediately. Second, if you absolutely cannot walk away, reduce your position size by 90%. If you are wrong, it is a small loss. If you are right, it is a small win. Do not increase risk to chase happiness. Part 9. Revenge trading and the caveman brain. One trader revenge trades immediately after a loss. Another trader is a recovering alcoholic. He knows that revenge trading feels like an out-of-body experience. The key point is that we have a caveman brain not wired for modern screens. When we feel risk or loss, emotions hijack logic. The fizz is that after any trade, win or loss, you set a 10-minute timer. You are not allowed to trade again until the timer goes off. This breaks the adrenaline loop. For the alcoholic analogy, in drinking, more alcohol only makes things worse. In trading, your brain thinks pressing the button again might make the money come back. You must reframe this consciously. Tell yourself that more than 3 trades is like getting drunk. It will only destroy your account. Part 10. Prop firms, tool or trap. There is a debate on prop firms. Umar is clear on the business model. The key point is that prop firms make money on your fees. They need you to fail. If every trader made money, the firm will go under. The risk for a beginner is that prop firm rules, such as profit targets and drawdown limits, make you trade around the rules rather than around the edge. You end up collecting bad, bent data. You turn the challenge into a slot machine. His recommendation is to use your own small capital first to prove your strategy with raw data. Only use prop firms as a bridge to scale after you are already consistent. Part 11. When to take profits, the ball analogy. Umar gives a simple analogy for managing open profits. If your target is 20 pips and price starts at 19.80, your risk to reward has changed. You are now risking 1 pip of profits to make only 0.20 pips. The key point is that for developing traders, it is more important to lock in a win and see green than to hold for perfection. Build confidence through small, repeatable wins. The fizz is that if price totals near your target, take the profit immediately. Do not wait for the exact number. Do not move your stop to break even and hope. Take the money and close the trade. Part 12. The never arrive mentality and final advice. A trader asks when he can say he has arrived. Umar answers, never. The final key point is that just because you made money yesterday does not mean the market will give you money today. You have to earn it every single day. Stay on your tiptoes. The correct order of operations is as follows. First, get a proven strategy with a real approach. Backtest it. Forward test it with tiny size. Second, only after you have a proven edge, work on your psychology, discipline, and sizing. You cannot work on the 7th floor of a building before you build the base. The final advice from a successful participant is to never quit. Treat trading as a journey for life. Keep self-improving both on and off the charts. The micro changes compound over time. If you found this breakdown useful, like and comment your biggest takeaway below. Links to the full original video and resources are in the description. Trade well. Bye for now. If you want to learn how to trade Forex, then I will leave a link to a recommended course. Once you begin that course, start putting everything you have learned in this video into practice.